Thank you, Marcus, and the Accelerated team, Tiffany, Macy. This has been a great event. I'm happy that there wasn't a mass exodus when everybody saw the accounting guys come into the room. So this is a good sign. It's a great start. So we just wanted to run through what to expect in this presentation. Quick introductions, get to know and trust who we are and our background and what we do at Liguori Accounting. Objective, are you the right size? Things to look for. In right sizing, why do the dollars and cents matter? Accounting considerations, identifying healthy financial statements, identifying tax opportunities. I think a lot of people are excited about that, especially coming off tax season. Our approach, and then how to get in touch, and some helpful resources for you moving forward.
All right, so I'm Nick Liguori. I'm the owner and founder of Liguori Accounting. I live in Newmarket, New Hampshire, small town on the seacoast, and with my wife and 4 kids, as you can see up on the screen here. On the left, that's the 4 of them, a recent vacation down in South Carolina. And yeah, so I started Liguori Accounting. I'm a CPA. I've been licensed for over 10 years. And my background is I started off in public accounting, typical tax, audit, firm, did that for a number of years. And then I was in corporate accounting in the oil and gas industry for a period of time. At that point, I started picking up some tax and bookkeeping accounting work on the side, and that started to build. And it was, around the beginning of 2020, got to the point where I made the decision to leave my full-time job, pursue this full-time, and that's where Liguori Accounting started, right at the beginning of COVID. Perfect timing to start a business, and it's all history from there. So we've grown our team since then, and focused in the medical aesthetics space, which happened organically. One of my first clients I started working with was a local med spa, decent size in the area, and that led to some referrals, which got us involved in the New Hampshire Association for Medical Aesthetics, which then brought us to AmSpa and where we are today. So our continued focus is in medical aesthetics and serving practice owners like yourselves. Yeah.
Love working with practice owners. They're a fun group of people too. They're passionate about what they do. My name is Dan Simard, also from New Hampshire. I don't know if you're familiar with our state motto, but it's live free or die. And I say that flows through my veins. Dan Simard, I have a special license. It's called an NOT CPA. It's a special license that you get when you spend enough time with a CPA. So I'm not a CPA. I was brought on by Nick in 2022, right? Yep. 2022. And I call myself just the hype man for accounting. Everybody needs a hype man when it comes to accounting and tax. So blessed with an amazing family, 2 kids, Josephina and Ezekiel. And then my hero in the middle, not me, that's my wife. my hero, she's incredible, not worthy of her. And my background is kind of unique. So I have a business degree, I've done accounting classes, but I also have a philosophy degree. So I have the business and ethics, I like to say. So, I utilize that. I've worked in a lot of different fields. I used to be an educator. I was a school admin at one point. I worked in insurance as well, and I also worked for the post office. So I like to say the commonalities between all those things is, a love for people, a love for efficiency, a love for excellence, and I bring that to what I do. And so that's what we do here, and growing in this field and enjoying every minute of it, and meeting an amazing group of people like you, a high caliber group of people. So it's been great. Our objective here is just simple, to provide you with bookkeeping, accounting, tax insights to consider, take away with you when evaluating your practice. Office people, I love the office. We know this look. We know accounting and tax isn't the most exciting. This is called I'm sleeping with my eyes open. So we're gonna have Brandon gently walk around. If he sees anybody, I'll point them out and he'll gently nudge you, wake you up. But we'll keep a good pace, we'll try to.
All right, so the big question here is, are you the right size? feel free to jump into throughout with questions, and we should have time for questions at the end too. But yeah, are you the right size? And there's no one right answer here. There's a lot of things to consider to determine that, and starting with your goals and your vision. So not everyone's goals are going to be the same with their practice. Maybe you want to have 5 locations. Maybe you want to have a single location and be a solo provider, and that's great. But those goals and that vision is going to determine what size your business needs to be, right? So that's as far as location size, but also from a financial standpoint. There's only so much you can do if you're a solo versus if you have a team of 15, right? As far as revenue, there's a cap to that. You have limited time, you have limited capacity. So determining what that end goal is important to determine, are you the right size? Also involvement. So we all started a business with a different idea why you're doing it, right? Maybe it's money, maybe it's flexibility. We've talked about that over this weekend, but how much do you want to be involved in the business? Do you want to be there, 40, 60 hours a week? Do you want to be there 20 hours a week? Do you want to be there 5 hours a week? To do that, that's going to mean a different thing for how you structure your business from a financial standpoint, from a process operation standpoint. Also, exit strategy. So, 5, 10 years down the road, do you want to sell your business? Do you want to, how do you want to do that? And that's going to be, what do you want to get from that too? And your size is going to dictate that too. And, maybe the plan is to scale. You need to add locations to get that exit you want, or maybe you can do it with one location. A great book I would recommend, as far as if you ever do plan to sell your business, is Built to Sell. I'm forgetting the author's name off the top of my head, but if you Google it, I'm sure it'll pop up. It's a great perspective from that whole where you are today to where you need to go to actually sell your business and get the result you want. It's from the perspective of a advertising agency is kind of the business that runs through this. And it's really great. I would recommend it to everybody who at any point wants to sell their business. Lastly is flexibility and freedom. How much freedom do you want from your business? These things are all going to dictate, are you the right size, and help you answer that question. All right, so in right sizing, why do the dollars and cents matter? Accurate bookkeeping and record keeping is going to affect a lot of things. So we've talked a lot about KPIs over this weekend, of course. And from a financial standpoint, if you don't have up-to-date books, you don't have accurate books, your KPIs are meaningless because you can't trust that information. So, bookkeeping is really the foundation of your financials, and that the accuracy and reliability of that information. Your financial picture, operational efficiency, understanding, being able to look at a P&L. If you don't have the bookkeeping in place, that's going to be meaningless as well. So having that there as a foundation is important. Tax opportunities. We do tax planning with all our clients throughout the year. If you don't have up-to-date books, you can't do an accurate tax projection. So, a client comes and says, hey, I'm going to buy this machine. What is it going to do for my taxes? If you don't have up-to-date statements, we don't know. We can't answer that for you. So it's key to have your books up to date. Budgeting and forecasting. This is huge from a lot of different standpoints. So again, a budget and a forecast is going to help you have that roadmap of where you want to go, whether it's for the next 12 months or a longer period of time, 3 to 5 years, whatever it may be. If you don't have that roadmap, you don't know if you're on the right path. And what we do and what you should be doing is looking at your actual results compared to those budgets, those forecasts, and making sure you're still in line with that roadmap. Because if you're not, then it's time to address that and adjust and make sure you're back on the right path. Again, back to exit strategy, knowing your numbers, knowing the value of your business is going to be important to know if you're on the right path towards that long-term goal. And then last but definitely not least is confidence and peace of mind. knowing that your books and financials are up to date and accurate gives you that peace of mind to go forward day to day and make those decisions in your business. Like, if you don't, yeah, you can run your business from the cash in your bank, but that only gets you so far. You need to know what your profitability is, what future cash flow looks like, what expenses are coming down the pipeline, to be able to make those decisions confidently and, move towards your goals with the business. All right, so now we're going to dive into some of the key accounting considerations that you all should be thinking about as business owners in this industry. So first off, CPOM states, know where you stand, know what the requirements are in your state. Obviously, make sure you're talking to a legal team to make sure you're structured properly, and that, also from an accounting and tax standpoint, you're in compliance there as well.
And for those of you who don't know, the CPOM, Corporate Practice of Medicine Doctrine, that's what he's referring to in your state.
Yep. So some states obviously are going to require an MSO model to be in place. With that, make sure you're doing that properly. Get it set up. Make sure your books and records are also reflecting the MSA agreement that you have. If they're not, you're going to run into trouble down the road as far as, there's two distinct entities here in most cases, and they are going to have different ownership structures. They may have different tax filing requirements. If you don't know that from the start, it's going to be hard to correct course on that. We've definitely come across that previously. Yeah. But when you get it started on the right foot, yeah, it's more complicated. It's another extra step to deal with in your bookkeeping and tax work, but compliance is key. Like, that's the last thing anyone wants to deal with is legal or tax issues, right? So,
and the MSA, for those of you who don't know, is the Management Services Agreement between those two entities, the clinical entity and the MSO, the Management Services Organization. That just dictates the flow of money.
Anything else I'm not touching on that?
No, I'm just interpreting your acronyms. Translating.
All right, equipment and leases. This is another big one. Obviously, I'm sure all of you have expensive equipment you're operating in your practices. Making sure those are on the books properly is important. You're purchasing a fixed asset, and oftentimes you're going to have a lease or a loan associated with that. So having those on your balance sheet properly recorded is important from one, like an accuracy standpoint, because if you don't, it's going to impact your profit and loss. Also going to affect your taxes if that's not recorded properly. So with equipment, you want to be able to take advantage of the tax opportunities and planning that goes with that, whether it's taking bonus depreciation on that equipment in the year you buy it, being able to which means taking all of that deduction in 1 year, or depreciating it over a number of years and stretching out that benefit from a tax standpoint. So there's a lot of planning you can do with that. And it's one thing you want to make sure, reach out to your accountant or tax professional before you buy equipment, not afterwards. Make sure it's going to be, they're aware of it. They can help you plan from a tax standpoint of what that impact is going to be. And timing can be really key with that. Like, if you're at the end of the year and you're thinking about buying equipment, there may be a lot of benefit to buying it before year end versus in January, or vice versa, depending on what your financials look like. So another reason to make sure your books are always up to date. Next is package and gift card sales. So this is an important one as well. Actually, I skipped over accounting basis, so I'll loop that in here. So accounting basis means, so there's two different types of ways to do accounting: cash basis or accrual basis. Anyone know the difference? Want to jump in on that? Probably not.
Oh, there we go.
Got one. All right, here we go.
I'll give it a try.
Yeah.
All right. So the way that I understand it, cash is cash in, cash out. Whenever the cash comes in, and when it leaves, and then accrual has to deal with more of accounts receivables, when you have things that you're going to get paid for in the future, but it's pretty much when you count it into the profit and loss.
Yep. Yeah. Right on. So cash basis means the activity is recorded when the cash either comes in or goes out. So that's when it hits your books. Accrual basis is, like you're saying, you're hitting the balance sheet more. So there's liabilities, or accounts receivable, accounts payable, but also you're recognizing sales when they occur and expenses when the sale occurs that's associated with it. So the biggest difference here oftentimes is with cost of goods sold. Oftentimes, on a cash basis, when you buy, $25,000 worth of product, that's on cash basis, that's hitting your profit and loss the day that money goes out of your account. On accrual basis, you're spreading that out to more accurately match, when you use it, when you're delivering services. So the accrual basis gives you a more accurate picture of, how it more closely maps with revenue. The costs and revenue match up.
And it's helpful in an operational standpoint. So you get a better picture of your operations, like that's been mentioned before. Understanding getting an idea of the operational P&L. Accrual basis would be a necessity for that.
Yeah, so it definitely gives you a more accurate picture and gives you less of the ups and downs on costs than if you're doing cash basis when you're buying product in bulk and things like that. So that sort of ties into package and gift card sales as well, because with that, when you sell a package, you're not delivering all those services the time you sell the package, right? Like that's going to happen over time. It could be an extended amount of time. So that's really a liability at that point. So that really should be on your balance sheet as a liability. And then as those services are rendered, as that package is used up, that's when that revenue is really recorded on an accrual basis. Cash basis, obviously, you sell it, the package, and then that revenue hits your P&L the day you get the cash. So that's the big difference there. Again, it's like there's a difference between obviously the cash flow and when those numbers are recognized on the P&L when you're on accrual basis. So a little bit complicated, but accrual basis, I guess, gives you a more accurate picture of what your business is doing. And neither is right or wrong. It's just different methods. So that's the big thing. Like if you're on cash basis, it's not like, oh no, I need to go and switch right now and make a big conversion. It's just understanding those differences and what they mean is important. Lastly, which we've kind of already touched on, is inventory and cost of goods sold. So again, going to tie in somewhat to the cash and accrual, properly recording your inventory and cost of goods is important to be tracking throughout the year for tax considerations and understanding your financials. All right, so identifying healthy financials. So this really ties into the right size. There are definitely some metrics we like to look at in the industry from our experience with our client base. We have a simple spreadsheet that anyone that's had one-on-ones where we've worked with them on that, and we'll post it in the Accelerate community page as well, so anyone can access it after. But basically, it helps you determine if you're in line with these key metrics.
And feel free to use it internally. Feel free to give it to your bookkeeper or accountant that you're working with right now and let them use it. If you don't have time, let them track it because you can do it over a course of a year. It's very simple and bare bones, and then it'll produce a nice graph so you can look back after that year. So definitely feel free to share as well.
Right, and these are some really simple profit and loss KPIs to track and make sure that you're just in a healthy place with the industry averages and where people typically fall. So first, cost of goods sold. Generally, this is all relative as a percentage of sales. So cost of goods sold, we like to see around 30 to 40%, ideally. Gross margin, so this is revenue less cost of product, cost of goods sold. Between 60 and 70% is a healthy place to be falling. Payroll between 25 and 35% is typical for what we see. And the one big thing I always like to tell people is you need to include yourself as the owner here. If you're not paying yourself a salary, you need to then factor in what you're paying yourself or what you would need to pay a provider that's doing the job you're doing. A lot of people who are in an early stage aren't paying themselves yet, or just paying themselves the bare minimum that they feel like they can comfortably afford. So when you're looking at these numbers, though, you want to factor in, like, if I had to hire a provider to do what I do every day, what would it cost?
And benefits is included in this as well.
Yeah, we look at overall payroll costs, so like payroll taxes, benefits, compensation. Facilities costs, so your rent, utilities, anything that falls into that category, around 10% or less is ideally where you want to be. This is going to change depending on how what your revenue is too. So early in your life cycle, this may be a higher percentage of your revenue than later in the game. Advertising and marketing. So there's going to be a big range here too. We like to see anywhere between 2 and 5% is a healthy place to be. Obviously, you want to maximize, like people have talked about today, maximize the free marketing tools that you can before you get into deep marketing spend. But obviously, if you're in a growth stage, it's important to invest in marketing efforts and, you know, bring in that new patient base and grow. Other operational costs, depending on how your spend is in other places, is going to be between 12 and 20%. And then lastly, but definitely not least, is net income. A healthy place to be there is between 15 and 25%. The bare minimum we like to see is a 10%, but like best case, you want to be targeting. Usually when we're budgeting, we want to target like around 20% with our clients. So another great book, we were talking about this with some people yesterday, is Profit First. If you're not familiar with that, look it up. It's a great read as far as helping you budget and build in profit into your budgets. And really that starts with at the bottom and works its way up. So you start with a profit in budgeting for that profit, and then working your way back up your profit and loss and budgeting for your costs, and then determining what revenue you need to hit that profit margin that you're shooting for. So another recommendation I'd make.
Hope we haven't lost you yet. We're getting to the great part right here.
Yeah, now for the real fun. So, any questions actually before we jump on to this tax segment here?
For the book Profit First, is that by Mike something?
Yes.
Michael, I can't say his
Michaelowicz or
last name.
something?
Okay,
Yeah.
I'm looking
Yep.
it up. Thank you.
Yeah, that's the
my
one.
question. Okay, thank you.
For, let's say, if you do cash or accrual, can you do both, or should you do one or the other? What do you like as far as businesses?
Yeah,
going?
good question. So from a tax standpoint, you elect one or the other, and you use that consistently. But you don't necessarily have to look at it, you know, in your accounting day-to-day reporting. You don't need to look at it the same way you do for taxes. It's important to have that tax basis locked down, but if it makes more sense to look, if you file taxes cash basis, but you want to see your books on accrual basis, you can do both. Most softwares, the accounting softwares, allow you to switch back and forth, just reports, really simply. So if you need to switch, it's easier to go from accrual to cash and get accurate picture versus the other way around. But yeah, you can definitely look at both.
When I'm going back to like short-term liabilities with package sales and such,
Sure, yep.
is when you're looking at those numbers, I mean, it depends on treatment usually, right? Like when they should be coming in for their microneedling package of 6, you know, whatever it is.
Yep.
But numbers wise and maintaining that, do you all look for a certain time frame of when those should be rendered and redeemed? What's your best practice for that?
Yeah,
businesses?
I think the key there is, do you have a policy in place of a timeline they have to use it within? And then what we would do is look at the list of outstanding packages, and are there ones that are getting old or, you know, older and haven't been used? And then maybe it's a process where you reach out for anyone that's over, you know, 6 months and hasn't utilized their package and get them on the books. So you really don't want that liability to continue to build. If you do have a policy in place where it's like, if you don't use this within a year or, you know, some time frame, then it's something you can write off and recognize that revenue after that lapses. So there's a couple ways to handle it, but I think you have to go back to whatever type of policy you have first. And then I think managing that is the next big step, is like, okay, the ones that are getting older, you haven't heard from in a long time, reach out and get them to come in, right? Does that make sense?
Yes, thank you.
Sure. Anybody else? All right. Identifying tax opportunities. So first off, your business structure is really important. So knowing if you're a single member LLC, are you a partnership, are you an S corp, are you a C corp maybe? So depending on your structure, what tax filings you're required to do each year is going to be different. But knowing your structure allows you to properly plan. So for example, if you're an S corp, you need to be paying yourself a wage as the owner, and that gives you the flexibility to plan, you know, how much are you taking through payroll, how much are you taking through owner's draw to maximize the tax benefits from that structure. Similarly, with any other structure, it's important to know how you pay yourself, which we'll get to as well a little further along. But then also with structure, if you have an MSO, again, that's super important as far as from a tax standpoint, making sure you are properly filing the taxes you're required to under that structure. Oftentimes there's 2 tax filings, and it may be one on your personal and then a separate, oftentimes an S-corp filing that goes with it for the clinic entity. So knowing the ownership structure of each of those entities is important to make sure you're in line with that filing requirements, but also an opportunity to optimize your tax position. So within the MSO structure, you can, how the MSO, administers their services to the clinic entity can really transfer the income back and forth. And if you have different ownership structures on each of those entities, it can impact your tax position or anyone that's involved tax position if you have multiple people involved in the company. So important to know what those requirements are in order to properly plan from a tax standpoint. Equipment purchases, depreciation, we touched on this earlier. If you're buying equipment, timing matters, and knowing where you're at from a financial standpoint really matters, because it may make the most sense to take that depreciation in the year you bought it to minimize your tax liability this year. Maybe it's a down year and you don't want to use that big deduction this year and you want to push it to future years. So there's some variables to consider there. Cash and accrual we've touched on. Cash versus accrual, there's going to be a timing difference of what your taxable income is. So on a cash basis, it matters if you make a big product purchase on December 31st, that's going to make a big difference versus on accrual, where it doesn't matter as much because you're not recognizing that expense on accrual basis until you've actually used that product. So again, the biggest thing comes down to, are you keeping your books up to date to do that proper planning and know your tax position before you get to April and you have to pay that bill? Business and personal, this is a friendly reminder from your bookkeeper, whether they're here or not, to keep your business and personal separate on your books. Also, your business is going to impact your personal taxes when we're talking from a tax standpoint. So make sure you have, your CPA you're working with knows about where your business is at, but also other personal factors that are going to impact your taxes. It all goes together. Like, you can't separate them in most cases unless you're a C Corp, which is pretty uncommon, I think, for small businesses nowadays. So if you're an S Corp, a single member LLC, a partnership, that income is taxed at the personal level. It's not taxed at the business level from a federal standpoint. So, any other income you or your spouse has, that's all has to get factored in when you're doing tax planning. So make sure you don't keep it siloed. You need to look at it as a whole. Owner's compensation. I'm sure this isn't a big topic for everybody that you're thinking about, is how am I going to make money from this business, especially in the early stages, and what's the right way to pay myself? So from a tax standpoint, you have a few different options, but it also depends on your tax structure of what the appropriate way to do that is. If you're an S Corp, you have to pay yourself a salary. The IRS has a rule in place that's called reasonable compensation. They require the owner to pay themselves reasonable compensation. And what does that mean? It means that it's a vague definition by the IRS, but it means that you need to basically pay yourself an equivalent of what you would have to pay someone to do your job. So there's a lot of wiggle room there, but you have to pay yourself through payroll with an S Corp. If you're not an S Corp, LLC, or partnership, you pay yourself through owner's draw or guaranteed payments. And these are taxed differently. So you pay self-employment tax on owner's draw, or your bottom line income, really, if you're a partnership or an LLC. So a number of different considerations there. But the big key is know how you're being paid and how that's being taxed. The last thing anyone wants is that surprise at the end of the year where all of a sudden you owe a huge amount of tax and you weren't ready for it and you didn't plan for it. paying estimated tax payments quarterly or throughout the year will help balance that out and smooth that cash flow hit, then rather than if you wait till April 15th to make that payment and you have to make that all in one chunk. So that's one of my biggest pieces of advice I like to give new business owners is make sure you are making estimated tax payments and you're planning for that tax, or setting money aside at the least. Profit First sort of has that built into it, where you set aside a certain percentage of every dollar that you earn for taxes. So that money is earmarked for it, it's set aside, and you're not spending it in other places. And lastly, proactive tax planning. This is huge, and what we like to do with all our clients is, if you're working with a CPA and you're not doing this, ask them to do it with you. Do a tax projection at least periodically, at least once throughout the year. We do it quarterly with our clients, so they know where they stand throughout the year, and we're looking at real numbers each quarter to determine where they're headed from a tax standpoint. It helps them make decisions throughout the entire year rather than at the end of the year scrambling to say, oh man, I need a new device, should I buy it now? And they have a short window of time to do it to get the tax benefit. So we like to keep on top of that with our clients.
And we always like to say, Uncle Sam is here to remind us that the more success you have, the more the government is going to want from you. So instead of the word tax breaks, we like to use the word tax strategies, because there's only so much you're going to be able to do to mitigate the tax liability you are going to be responsible for. But there's a lot of good planning that you can do. So there's a lot of great strategies you can put into place. But you want to be successful, and unfortunately the way our country's structured is Uncle Sam is going to want you to be successful and want a piece of it. But we can certainly help plan, and your CPA can too. So we just wanted to quickly touch upon our approach. So we like to call this business model a team of three. So everyone who works with us works with a team, and we like to consider it kind of your outsourced accounting department. So a team of three approach. Everyone on our team, the three people that are working with you, are focused on you. We have accountant. That's your daily contact. The biggest thing here, Chris, he left, but he'd be proud because these aren't stock. These are our real employees.
This is our team.
This is part of our team. So the daily accountant, the daily contact. What differentiates us is everyone on our team, with the exception of myself, because I have different responsibilities, is an accountant. So that's important because anybody can be a bookkeeper, right? You can get your QuickBooks Pro Advisor certification. You're a bookkeeper. Not every bookkeeper is an accountant. There's a difference. There's formal education in place. There's experience. There's knowledge of generally accepted accounting principles. So everyone on our team, that's really what provides the premium service. And that's why we're focused on this business model, is it helps us to ensure premium service is delivered. And a lot of, this isn't something we made up. We're piggybacking off of a lot of other successful outsourced accounting practices. So this is your daily contact, The great smile, this is the person you're going to become very familiar with, very friendly with on a daily basis. Maintaining your accounts and contributing to it in a proactive approach because they are an accountant, because they know how books should look like, and knowledgeable of accounting practices. They're doing payroll administration, so we don't provide a payroll software. We piggyback off of great companies like Gusto, or QuickBooks has a payroll solution, or ADP, and we help you to manage that system, manage your employees on there, process payroll on a bi-weekly, weekly, whatever kind of frequency you have it. They're looking at your monthly reports, so that's your first set of eyes right there on your not only on your books but on your reports in general. They're looking through your P&L balance sheet, making sure everything looks in order. And then sales tax filing. In most states, you have a filing requirement. We provide any sort of compliance support in that regard if you choose to use our team for that. Then you have the second level, the controller. So this is another level of expertise. So this is the reviewer and reporting whiz. So they're the second pair of eyes on your books and your reports. So the reporting whiz, they're in not only your QuickBooks and experts at Excel and doing custom reports if it doesn't exist. They help to put it together for you. They're also in the EMR, so we have a lot of experience in different EMRs. Shout out to Aesthetic Record, one of our favorites, absolute favorites. The reporting that you can get from Aesthetic Record is top notch, and I'm sure it's going to just keep improving. So they do the month-end books review. So not only is your bookkeeper closing out the books in a timely manner, they're doing the review. So again, the second pair of eyes, which is huge. And then they help the accountant, they support them in anything that might be above their level of expertise. And they have tax experience as well. So this gentleman in particular is close to his CPA.
Yeah, and this is also the person that's going to help you track all those KPIs that are important to your business, whether it's financial from the P&L or other more in-depth KPIs that need to come from Aesthetic Record or your EMR, whatever it may be. Our team can help you do that, and your accounting team should be helping you do that. It's something we can take off your plate. You are busy practice owners. Your time is more valuably spent running, seeing patients, running your business than it is, tracking numbers. So we can help compile that data for you and, allow you to make decisions from that.
This is one of my favorite pictures. If anybody follows us on social media, probably not a lot of you, but on LinkedIn, sometimes we put like a funny, accounting joke or dad joke, and then I post that picture. He probably doesn't like it, but I like it, so I use it. This is the strategist. So this is at the highest level. We are true financial experts. So that's what we're focused on. The distinction we like to make between, a CFO and a COO, we're truly focused on the financial picture. That's what we help guide and advise you on. We can speak intelligently because we're familiar with this industry. But if you're looking to work with someone who's going to really help you implement systems, structure, process, and really be on you on a day-to-day basis to help you improve that efficiency, fine-tune it, work with your staff directly in terms of like training and education, that's more of like a COO or a coach. We're true financial experts. We can, again, speak intelligently about what is the story your numbers are telling you about your position, and then what could that be indicating. So this is, again, third pair of eyes on the reports. Review quarterly and monthly reports, consult above the experience of both an accountant and controller, so at the highest level, schedule and run CFO meetings on a monthly or quarterly basis, and then organize other professionals. So we have a lot of partnerships that we're continuing to build. Again, high caliber of people and partners here. Incredible people like Aaron and others and Brandon that we're starting to form more connections with. So when there is a need, we can at least make those connections, which is helpful. That's relevant to this industry.
And we can finish it here. At least people can get it.
All right, so we're closing out our time here. So a couple things. You're going to get a spreadsheet. Hopefully that'll be disseminated in some way. We'll figure it out. But if you don't, please use this QR code. It's just a time to book with me or reach out, email me if you want that, and you really want that spreadsheet. You want to make sure it's not missed. If you want to learn more about what we do and how we might be a good fit, I'm the first point of contact. So I am the sales, the marketing, the onboarding. So I bring you from the first touch point through onboarding and introduce you to our team when it's appropriate. So I am the first point of contact, but I'm not the last, so I don't want you to be disappointed. You'll be able to work with incredible members of our team, but it all starts with me, and I'm happy to get to know you. And then, the QR code brings you straight to a meeting, and that's all we have for you. We thank you for your time, and we hope we kept you somewhat engaged throughout, but accounting and tax is tough, so thank you.
Thanks. Any other questions that we can answer before we officially wrap up?
Feel free.
Sorry, can you just repeat one more time?
Sorry. Yep. Go ahead.
If you're a
Susan.
solo owner and an S corp, do
Yep.
you have to be a MSO?
Not necessarily. I think that's going to depend on your state.
Yeah.
So it's a state by state thing. That's definitely a legal question. If you have an MSO or you don't have an MSO, I guess is your point, right? It also, it depends on the state. It depends on your qualifications too. Some states require a physician to own the entity that's providing those services. So it varies. I guess there's not a straightforward answer on that. But I would say
both do it then.
reach out
I
to
didn't know.
legal
You know
to
why?
consult on
'Cause
that
we're
one.
Like fight or people, so like we're ready.
Any other questions?
don't-
Going once,
I
going
don't-
twice.
Another final offer I wanted to
So
make,
I
and I
was great,
forgot to
and he's
mention
like,
it.
"I'm a
Anyone we
bitch."
didn't have a one-on-one with, we're happy to do so after this, and
Yep.
without charging. So I just want to make that final offer. Anybody we didn't have a one-on-one with, happy to do so.
It's free.
Yes, exactly.
It's
Take
free.
advantage
Take
of the CPA while it's
advantage.
free.
What was that first book you mentioned? I
The
knew
f-
I got Profit
The first one was Built to Sell.
Built to Sell. Built to Sell, everyone.
Yeah.
Okay, awesome. Thank
All right,
you.
thanks for having
Great.
us, everybody.
Thanks
Thank
very
you.
much.